Hi there, welcome to another episode of Property Talk with Terrence. This episode is a continuation of the previous episode in which I was expounding on the virtues and the benefits of leveraging on property in Singapore as a form of passive retirement investment and really investing in property with an end viewpoint for passive retirement income. In today's episode, I would just like to talk about the 6 fundamental pillars of real estate and the characteristics of real estate in Singapore that really make it such a viable instrument. There are 6 key, in my opinion, pillars or characteristics. The first one, all right, is like full ownership. It is very important to hold physical title and to have complete control over your investment. And that is what makes it so strong. When you have complete control, you really have 100% say over everything that the company does. You cannot, for example, if you invest in a stock, in a share, if you invested in High Flux, for example, you can't say, Miss Oliver, please don't invest in Tuas Spring, and then boom. So just as a backstory, High Flux was one of the investment darlings of Singapore, but the whole business went bust and the whole listed company all went bankrupt. I think investors lost about 900 million to almost like $1 billion. And basically, the premise was, as a business, High Flux was a water company, and then they went into the electricity generation business. Now, if you are a CPF investor or you're a stockholder of them, you can't say, I disagree, I disapprove of you going into this business. You can't. And that is why when you do invest in stocks and shares, you have no complete control because you're investing in somebody else's business. But in property, you have full, complete control. You hold physical title. Nobody can, for example, take a second mortgage off you. Nobody can say, hey, shall we go rent, lease it to this or that. You have full, complete control. Nobody can also say, hey, perhaps we should renovate your house or spend another 300,000 to go and fix it up without you agreeing. You need to have full, complete control. And that is the strength, basically, of property. Full, complete control. The second thing, it is very low risk. And I like to think of it as capital protected. What do I mean by capital protected? If I were to pose you this question, right, just pick any stock in the stock market. 30 years later, do you think that the stock might still be in the market? You can say for certainty, some stocks yes, but some stocks maybe not. Property, pick any property in the Singapore market. 30 years later, will the building still be standing there? It is almost with 99% certainty you say yes. Short of a missile in a war and, a torpedo blowing up the whole house, the asset value is there, the capital is there. You are buying into a physical hard asset and the physical hard asset will always be there. It is almost as good as buying a gold bar and putting under your pillow. But I said now you are holding title to a physical brick and mortar, rebar, stone, rock property asset. Which is why I like to term it as capital protected. Can it go down in value? Yes, of course. Will it evaporate and go to zero? No. Short of a war in extreme circumstances, but even then you have insurance, you see? Correct. Which is why I like to say that it is capital protected on the downside. The third, it offers very low risk leverage. Now the truth is, unless you are a private banking client, right? It is very hard for the layman to get financial leverage, You can't go to a bank and say, hey, I got 100,000 in the bank. Please lend me now 400,000, 500,000 so I can buy 500,000 worth of stocks and shares. You can't. They typically will look at your profile, etc., etc. So unless you have really well-heeled pockets and you are a client of Bank of Singapore, etc., you can't. Property allows you, in essence, actually 4 times leverage. When you buy a $1 million property and you only put in equity of 250K, you are in fact leveraging 4 times. You're borrowing the rest of the 750,000. And why does the bank lend? Why does the bank so freely lend to anyone in Singapore? Because the banks have also done their homework and they intrinsically know property when they hold the title. Of course, when they lend you money, they do hold your title in lien. So they are very comfortable with the asset value of the property. They are comfortable. Singapore is a strong, vibrant economy and a strong, vibrant place for property. And they're comfortable with that. And they're comfortable also to extend you pretty very decent, low percentage loans. So These bank loans are low, they give you good leverage, and that's where it's an opportunity for you to then partake in a leverage instrument. So now you are actually investing 4 times. I also like to post this to clients. Now, when you buy an investment property 1 million, you basically put down 250,000. Would you dare if I say, for this same 250,000 that you're offering, let me lend you 750,000 and buy $1 million worth of stocks? Would you dare to? Intrinsically, you take a step back and say, wait a minute, that is very risky, right? If I buy 1 million worth of stocks, if I drop by 10% to 9,000, I immediately lose 100,000. But why is it that everybody does it with property? Because we intrinsically know over the years that it is a very safe product. Interest rates are pretty decent and pretty low. Rental yields are strong. Tenancy and occupancy rates are high. And that's what makes it a low-risk instrument. Number 4, it is a very rare physical asset that can be monetized. What do I mean? So there are many forms of hard assets. You could buy a gold bar, but can you rent the gold bar out? Can the gold bar generate cash for you? You can't, right? Nobody will say, oh, okay, I'll rent that gold bar for you for like $1,000 a month, because there's no intrinsic use for it. What other type of hard assets are intrinsic users? Yes, cars, for example. If you're a Grab driver and you rent a car from Grab and then you rent, so yes, physical hard assets, like for example, transportation vehicles, construction cranes, all that kind of things, they generate monthly cash flow. Similar with property. The difference is almost all of them depreciate. You buy a car, 10 years later, you drive it around for Grab, 10 years later, it's depreciated. You're left with, what's the basic residual value? I'm not very familiar with cars, but you know what I'm talking about, right? You buy a gold bar, you can't monetize it, capital gain. So it's either A or B. Property is maybe one of the rarest products where not only is there a tangible, real physical use of it that the tenant will pay monthly cash for it as a form of rent, but it's also tracking inflation and it increases in value. So very rare, it is a monetizable asset. Number 5, no business risk. When you buy a stock or share in Netflix, StarHub, HighFlux, etc., you are buying into businesses. You're exposing yourself to business risk. When you buy into HighFlux, you expose them, or you are going to the business risk exposure of them going from water to electricity. When you invest in telco, StarHub has dropped, for example, in the last 15 years, I think from $4 to $1. Why? Because there's business risk. There are new competitors coming in, Netflix, etc., etc. So when you invest in stocks and shares, there's business risk. Correct? But when you do buy a property, it is essentially just tied to population demand. Population must go up and tenants must be there. It is only that risk. So if you pick a strong country like Singapore, like I have explained in the previous video, where we are landlocked and there are 2 million foreigners, then you are just tracking on that risk alone, and on that basis, I will say that it is good. Number 6 and the last, capital gains. Property has always been a natural inflation hedge. It doesn't go up and it shouldn't shoot up too much unless it's a bubble, but it is a major component of inflation. Every year, 2-3%, 2-3%, 2-3%, it naturally inflates and it hedges your money. It is definitely much better to put your 250,000 in a 1 million property to earn a 2 to 3% inflation hedge on your total 1 million value, rather than to leave your 250k in the bank earning 0.1%, or even like a fixed D, because fixed D rates do go up and down. So you can see there are different magnitudes to it. When you put in 250k, you're buying 1 million in value. 1 million in value enjoys inflationary pressure upwards. It increases in capital value every year, 2-3%, 2-3%. Next year, 1.02, next year, 1.04, slowly. But after 10 years, if you compound 2%, it's actually about 25%. After 20 years, it's almost like 60%. And that is the beauty of property. It is like the tortoise going forward steadily and not the hare. So, and that is the strength of it. See? So with these 6 things, I hope I've adequately explained why property is such a strong product, I would say, as a form of investment for your money in Singapore. Thank you. If you like what you hear again, please smash the like button. And again, if you do need some more bespoke, personalized advisory, please feel free to reach out to me. Thank you very much.